Hi guys, if you have been watching SoFi recently, you probably heard this a lot. Once interest rates go down, SoFi is done. SoFi makes money from their loan interest. So if rate cut comes, its profit will get crushed. And now the stock price is down about 50% from its high. But I think this is half right and half wrong. Today, we are going to look at where SoFi's business model is going and why the market may be overreacting and give negative views to this company. Before we start, I upload the market insight and breaking news every day on my YouTube shorts. I believe this will help your investment decision, so please check it out and subscribe to the channel so you don't miss any market update. Okay, then let's get started now. If you only see SoFi as an online bank and the lending company, then this concern may sound right. But if you look at deeper, SoFi is not just a simple bank. It is a digital bank, a lending platform, an investment app, a payment system, B2B financial tech, and now even a stablecoin system. In today's video, I will explain what SoFi really is, whether rate cuts are truly bad for the company, and why the market start looking at SoFi risk differently again. Let's start with the numbers. SoFi stock is currently trading near around between $16 to $17. Its market cap is about $22 billion. According to Yahoo Finance, its forward P ratio is about 26 times and its price to book ratio is around 1.9 times. If you look at SoFi as a normal bank stock, yes, it looks a little expensive. But if you look at it as a growth fintech company, the price is actually pretty attractive. Why? Because SoFi's recent results are stronger than many people think. In the first quarter of 2026, SoFi reported adjusted net revenue of about 1.087 billion, up 41% compared with the last year. Adjusted EBITDA was about 340 million, up 62%. Net income was about 167 million. The number of members grew to 14.7 million. Total loan origination reached $12.2 billion, which was a record high. So, if we look at earning, this was actually a very solid result. But why the stock price is not doing well? That's the question. SoFi makes money from loan interest. If interest rates go down, loan rates will also go down. So people start to worry about their loan interest income will go down as well. As people expect rate cuts under a new Fed chair, fear around SoFi is growing. And yes, this concern is not completely wrong. Interest income is very important for SoFi. In first quarter 2026, net interest income was about 693 million, up 39% from last year. So if rates go down, SoFi may earn less interest on each loan. But we should not stop here. When we look at rate cuts, we should not look at only one side. First, when rates go down, loan rates may fall, but loan demand can rise. For example, when interest rates are 10%, people hesitate to borrow money, right? The monthly payment is too heavy. But what if the loan rate is only 3%? Demand for personal loans, student loan, refinancing, and home mortgage loans can come back. SoFi may earn a lower margin on each loan, but if total loan volume grows, the total revenue can hold up better than people expect. That is the first point. Second, when rates go down, the interest cost SoFi pays to deposit customers can also go down. When we deposit money at SoFi, SoFi has to pay us interest. In a high rate environment like today, SoFi has to offer a high APY to customers, so the cost is high. But when rates fall, these costs can also come down. In first quarter 2026, SoFi explained that its deposit-based funding helped the company borrow money at a much lower cost than traditional warehouse funding. This structure created about 621.8 million in annual interest cost savings. Therefore, rate cuts are not always bad for SoFi. Loan interest income may face pressure, but loan demand can rise and deposit interest costs can fall. And then third point is even more important. SoFi is no longer just a lending company. The real change is that SoFi is moving toward becoming a financial system company. Inside SoFi, there is Galileo, a payment and card issuing system. There is also Technisys, a core banking platform. In simple terms, Galileo is a financial API that helps companies create, card, process payments, and add financial service. Technisys is like the heart of a bank. It helps banks handle deposits, loans, accounts, and payments through cloud-based system. Many old banks still use outdated systems. Trust me, they like even the big banks, they're still using the very old style systems. One system for deposits, another system for loans, another system for card, which is kind of annoying. So when they want to create new financial product, it takes a long time. Even if a bank app looks modern, the system behind it can be very old. SoFi is trying to change this structure. Consumers use deposits, loans, investing, cards, and crypto inside the SoFi app. Companies use Galileo and Technisys to build their own financial services. And later, SoFi connects 24-hour payment and settlement through a stablecoin like SoFi USD. If this works, SoFi will not be just a bank, it can become a financial platform. This is where the stablecoin story comes in. In the first quarter of 2026, SoFi started building a US dollar based stablecoin called SoFi USD. The company also announced a partnership with a MasterCard aiming to use SoFi USD as a settlement option inside a global payment network. SoFi also launched Big Business Banking. This service allows companies to hold, move, and settle dollars, crypto, and SoFi USD inside one regulated platform. Names like MasterCard, Galaxy, BitGo, and Fireblocks are also part of their partner system. Why does this matter? The old banking system is now slow on weekend. International money transfers are expensive. Business to business settlements takes time, but stablecoin based payments can move 24/7. If SoFi provides this inside a regulated bank, the market may start to see SoFi not just a simple bank, but as a regulated fintech and stablecoin payment system. I think this is most important re-rating point for SoFi. But of course, there are risks. The first risk is the technology platform. In first quarter 2026, SoFi technology platform revenue fell 27% from last year. This was partly because of one large customer left the platform. This dragged the stock price down a lot. Technology platform enabled account also fell 16% year over year. This is clearly something we need to watch. If SoFi wants to be recognized as a real financial system company, revenue from Galileo and Technisys need to grow again. It cannot be just like good technology. Real business customers must increase and revenue and margins need to improve. The second risk is credit risk. SoFi is also a lending company. If the economy gets worse and unemployment rises, late payments and charge-offs can increase. As of our first quarter, the company said credit performance was in line with expectations. But for a company growing loan quickly, we always need to watch credit quality. The third risk is that stablecoin story is still early. So SoFi USD sounds very exciting, but we still need to see how many customers will actually use it, how many companies will adopt it, and how regulation will change. Because there is already USDT and Circle's USDC, which is very strong competitors. In conclusion, SoFi does have risk, but I think the market reacted was a little too much recently. Because SoFi is already improving its profitability. Its member base and loan volumes are increasing super fast. And with SoFi USD, big business banking, Galileo, and Technisys, the company has a chance to move beyond a simple online banking and become a financial system company. So I don't see SoFi as a just victim of rate cuts. In the short term, the market and price can be a little volatility, but looking at this year, I think SoFi is one of the strongest growth stock that investors should watch closely along with AI related stock this year. But again, I'm not a financial advisor, so please do your own research before make any investment decision. If you like today's video, please hit the like and subscribe channel. I'll come back with another interesting company and market insight. See you in the next video.